Did you right away start looking at opportunity zones? How did you discover them?
I was at a CLE. I heard a guy talking about opportunity zones, and I was like, oh, that's like 1031 and private equity got married. Those are like perfect of what I've been doing over the last 15 years. I was like, I'm going to go try an opportunity zone deal. And so I've been doing opportunity zones ever since.
Hello, everyone, and welcome back to another episode of Paths of Progress. I'm your host, Alex Kononov, and today we are talking about one of the most powerful yet often misunderstood tools for building wealth and transforming communities, opportunity zones. My guest is Ashley Tison, is the founder and president of OZ Pros, where he helped investors defer over $1 billion in taxes and create over 900 opportunity zone business and funds. He's known for turning complex tax and investment strategies into clear, actionable playbooks that help investors keep and grow more of their wealth. Ashley, welcome to the show.
Alex, honor and a privilege to be here. I'm super stoked about talking you through OZs.
Thank you so much, and it's pleasure all ours. Opportunity zones is like a mystery in real estate world, and finally we found that wizard who can guide us through this process. But listen, Ashley, before opportunity zones, let's go back to the beginning. How did you first get into real estate?
Back to the start, right? So I went to law school and I got out and I started with a big firm, and it was sucking my soul, right? You know, with work hours, I was making a lot of money, but I was definitely not happy. And there was a guy in my, kind of friend network who had all of these rental houses around Charlotte. He had a day job too, but we would regularly go and we'd venture and we'd talk real estate. Real estate had been in my blood. My family has been in the real estate business since literally the Civil War and the timber business and other stuff. And so it was in my blood. I was fascinated by it. And he kept talking to me because he was one of the Carlton Sheets acolytes. And, one of their original, right before Bigger Pockets, there was Carlton Sheets relative to how you do deals. And so he told me, he was like, listen, man, he's like, the only difference between you and me, he said, is that I've just done a deal. He said, so the biggest piece of advice that I can give you is just get out there and do a deal. And so I did. I got in touch with a guy that had to sell stuff for when somebody went into a nursing home. They call them commissioners here in North Carolina. And I was talking to that guy. And I was going through some of the stuff that he had, and he had this kind of interesting opportunity. There was a lady that had gone into a nursing home, and she had an adult child, but he was kind of had the kind of mental state of like an 8-year-old. And so his church wanted to be able to let him stay in the home that he was in. And the lady had that home, and then she had another lot that was fairly close to downtown. I really wanted the lot, but I was at the point where I was like, I want to do some impact investing. So this will be an opportunity for me to do some good. And so I went to them and I said, listen, I will buy the house and the lot, and I will let him stay in the house, and I'll basically rent it to him for what my mortgage is. And so the commissioner approved the sale. It went through, and I got to build a great relationship with the guy that lived in that house. And like so much so that we would like take gifts by on Christmas Eve and that kind of thing. And so that was awesome. But the real value was the other lot that I had bought. And I sold it when the market went up. I basically kind of 4x'd my money on the deal. And I was like, all right, 4x, man, I don't know that I'm going to be able to do any better than that. So I sold the lot. Yeah, exactly. And I kept the house. And, I should have done looking back, I should have done the exact inverse. Now, I wanted to be able to keep the guy in the house, but he ended up passing away, unfortunately, about a year later. And that house became an albatross for me relative to trying to figure it out. And I basically ended up selling it for what I had in it. And I should have done the exact opposite, right? Sold the house as soon as I could to let somebody else deal with kind of the ins and outs and maintenance, kept the lot, which didn't require any maintenance, and is now worth probably around 100x of what I paid for it, being as close as it is to Charlotte. And so that's the lesson that I've taken from that. Don't get involved with things that have lots of moving parts and that have lots of management stuff. Get involved in the stuff that's as lean as possible with respect to management. And so that's what we're actually doing with our Opportunity Zone Fund, is that we invest into boat and RV storage deals that can be managed remotely.
We'll come back to your opportunity zone fund. But hold on. First lessons. I think we need to unwind a little bit. So not only, hey, listen, don't do this, but also understanding your strengths and weaknesses. This was a pivotal part, right?
That's right.
Hey, I'm not that good at managing. I'm not good at plunging toilets. This is not my thing. I'm an attorney. Maybe I shouldn't. This is not best ROI on my money, right? So you decided,
not highest and best use of my time. Exactly.
Exactly. And also don't get attached to real estate. It should be some business plan. If there isn't high, if you're making money on it, just let it go, move on to another project. There's many other projects out there, and I think that's what people missing out here. They get attached to it and they cannot sell, they cannot move, they don't progress. I'm guilty of this myself. But hey, I'm glad you still decided to sell it, right?
Yes,
and you decided to do something else with your life. So what was after that? Did you right away start looking at opportunity zones? How did you discover even that?
No, so I actually left the law firm and I went in-house with a commercial real estate developer, and we were a tenant in common syndicator. So we bought shopping centers by the gallon and we sold them to 1031 investors by the scoop. And so that was kind of my initial foray into kind of the tax advantaged real estate investing world. And we also raised an opportunity fund and we distributed that through a network of broker dealers, basically through Wall Street. And we would then use that cash to develop additional stuff. And then we'd put it through our tick syndication process after we had it developed and stabilized. And so I got a crash course in some really sophisticated real estate maneuverings that has been invaluable. And I left that when the commercial real estate crash happened in 2008. I went back to practicing law and I built up an M&A firm, and I was helping business owners to, bring Wall Street level sophistication to Main Street level transactions so that they could buy and sell businesses with comfort and with ease, and knowing that they weren't getting toasted by the professionals that were helping them. And we developed a software program to do that. I sold that business in 2018 in order to help business owners do succession planning and tax mitigation planning and keep more of what they made. And as I was at a CLE, I heard a guy talking about opportunity zones, and I was like, holy cow, that's like 1031 and private equity got married. Those are like perfect of what I've been doing over the last 15 years. I was like, I'm going to go try an opportunity zone deal. So I popped up a website, and within 2 weeks we had 150 inbound leads and $75 million worth of capital looking for deals. And I was like, I think we stumbled onto something here, guys. And so I've been doing opportunity zones ever since.
Wow. First of all, you got from residential, you jumped right to syndicating commercial real estate deals in a form of attorney, right? And
that's right.
Managing the whole thing, but it gives you attachment. But I think they also doubled in some opportunity zones. You just mentioned that you also had 1031 exchange people and doing some creative stuff with the tax deferment of capital gains. But now you actually discovered opportunity zones on the conference, right? On the CLE conference, you said. And that's what enabled you to go, hey, listen, that's where the light bulb came up, right?
That's right.
And this is what we need. This is what we've done before, but now we can do it even better. Now we don't have to defer capital tax gains. Now we can eliminate them.
That's exactly right.
And help people on their end. Okay, so from your first outreach campaign, you got so many inbound business. So what did you do with this? You started working on helping others, or did you actually work on capital raising, helping investors to invest in the opportunity zones?
Yeah, so at the outset, because it was so new at the time, we just did consulting, and I did it kind of like a law practice, and helped people to process through their own deals, and then help them find deals if they had money looking for deals. And we actually put together our first fund, and I wanted to do a roll up of businesses, because one of the great things about opportunity zones is that it's not just real estate. You can do operating businesses. So we were going to roll up construction cladding manufacturing companies, and they had a real estate component, but then they also had an operating business component. The industry was fairly fragmented. So we put together a fund to do that. And so I had to do a deep dive into the regs that were out there and into the different pieces of the law in order to come up with that fund. Spent about $75,000 on all the documentation for it. And then we went to market with it, and we could literally not raise a nickel. And it was I think it was all because of the timing, because the final regs hadn't come out. People weren't comfortable with like our stance relative to our interpretation of what was going to happen, which ultimately got confirmed, but it was just bad timing. I think the other piece was that, there's a different dynamic of people who are comfortable investing into real estate versus what people who are comfortable investing into operating businesses. And those two typically don't mix. And most of the people that are okay with doing kind of tax advantaged investing are mostly real estate people. So they didn't get the risk associated with operating businesses in the same kind of model. And that was an important lesson for me that I've been able to help my clients with as they've gone down the road of investing money, because we took those lessons from that failed fund and we went back to just selling shovels to people and helping people out to do their own deals and helping people to do both operating businesses and real estate deals, but usually not combined. And then along the way, I had some people that came and were like, hey, listen, we really want you to run a fund and to invest our money for us. And so that's when we went and we set up the fund. Instead of putting the fund together that I wanted to do and then trying to find investors, I let the investors come to me, and then we went out and found the deals that they wanted to do.
Love it. I have many, many more questions, to be honest. But I think for our listeners, we kind of need to step back and say, hey,
Sure.
Ashley, what is opportunity zone? And can you explain in a simple language for everyday people, like how to deal with it and what it is actually?
Sure. So they were created by the Tax Cut and Jobs Act of 2017. And effectively, the government wanted to incentivize private investors to take money out of kind of traditional capital markets and to invest those into underinvested areas. So Congress passed 3 pages of legislation in the Tax Cut and Jobs Act that gave the governors the ability to designate up to 25% of their low-income census tracts as opportunity zones. And if you put money into a qualified opportunity fund, which literally can be as simple as an LLC tax as a partnership, and you invested into qualified opportunity zone property, which can either be real estate or an actual business that's inside of that zone, then you get to defer your original capital gains tax for a period of time. You got to reduce that capital gains tax. And then after a 10-year hold, you got to eliminate that capital gains tax on the back end through a step up in basis to fair market value, which not only eliminates capital gains taxes, but it also eliminates depreciation recapture. And so the legislators, I got to hand it to them. They got the attention of private capital. They got it off the sidelines, and then they made it patient, all in 3 pages of legislation, which is unbelievable.
Honestly, I've been in real estate and I'm excited, and I heard about opportunity zones, but I never heard about the opportunity zones in actual businesses. So also mixing. So explain to me, so opportunity zone is the same map, right, for real estate for business. So within that opportunity zones, if the business is physically located in that opportunity zone, and then you can also apply the same strategy pretty much for 10 years invest in, and it's going to defer your capital tax gain, or not defer, eliminate capital tax gains.
So you got to start with a capital gain. That's the unfortunate thing about opportunity zones. And they did that because number one, they wanted to get kind of capital out of Wall Street. Number two is that they needed to make it finite for purposes of the budget reconciliation about how much tax they were going to be foregoing. And so that's the one kind of difficult thing, especially as it relates to operating businesses. But if you have an appreciated Mickey Mantle card and you go down and sell that and you generate $10,000 worth of capital gain, you could take that gain, set up your own fund, go start a new company that's the next Facebook, hold it for 10 years, sell it on the backside of 10 years for $1 billion, and you pay 0 capital gains taxes on that. And so it becomes really powerful for both startups and for businesses that people are acquiring that we can either move into the zone or that are already existing in the zone. We can basically freeze the value for purposes of taxes. And we can give them the next, they have to hold for 10 years, but you get to hold for 30 years. And so we can freeze the value for the next 30 years for tax purposes. That's really powerful.
It is really powerful. Okay. So what are the challenges there? I mean, a lot of people looking at this and don't know where to start. And where do you actually start, Ashley?
Yeah, so the first thing you got to do, number one, you got to have a capital gain. Number two, you got to set up a fund. And like I said before, a fund can just be an LLC taxed as a partnership. 3, you have to either acquire real estate via purchase or by lease. So if you're an operating business, a lease will count. And then you just have to comply with the rules. So if you're a business, 50% of your gross income has to come from a trade or business that's happening in the zone. That's tested by where your employees are, not by like where they actually go. And so you can go outside of the zone and do business, right? So you could actually have like a software development company that sells software around the world. It's just that your employees need to be located inside of an opportunity zone. And that's not the same zone. They could be in any opportunity zone across the United States, and there's 8,700 of them. And pretty much all of the island of Puerto Rico is an opportunity zone. And so it gets fairly flexible to where it's kind of like, okay, it's not necessarily what can you do inside an opportunity zone, it's what can't you do. And the things that you really can't do are anything that's like tied to kind of financial instruments. So a stock trading company would be very difficult to do, or something that has to be based on like high-end retail location. So if it's location specific, like a Louis Vuitton store, that's not going to happen inside of an opportunity zone. But the other thing about opportunity zones is that the demographics of them are a lot better than you might think, because the zones were chosen based upon the 2010 census tract and the governors back in OZ 1.0. I'll talk about OZ 2.0 here in a little bit, but they got to designate adjacent tracts too. So there's some zones that are unbelievable, like basically the strip down in Myrtle Beach, which is waterfront, oceanfront property. That's an opportunity zone. There's a place that's in Newport Beach, California, that's on the water. That's an opportunity zone. There's places in Brooklyn that are opportunity zones. I mean, so there's some really nice opportunity zone census tracts out there. You just got to get a little creative to find them, which you can do on our map at ozpros.com/map.
So, and you mentioned there's opportunity zone 1 and now opportunity zones number 2. So when was 2 introduced to equation?
That was done in the One Big Beautiful Bill, or OB3 as we like to call it. Opportunity zones, because they, number one, they needed to, they make it finite. And so they did that by making it capital gains, but then they also tied it to an end date. That end date was basically when the Tax Cut and Jobs Act expired, which was December 31st of 2026. And so 1.0 was set to expire at the end of next year. So a lot of people thought that the program had kind of timed out. And so One Big Beautiful Bill not only extended it, but they made it permanent. And so they said, listen, we're going to make this so that in 2027, there's going to be a new round of census tracts that get designated by the governors. And then we're going to make it permanent. And we're going to make it so that if you invest into a qualified opportunity fund after January 1st, 2027, you're going to get a rolling 5-year deferral. And then you're going to get a 10% reduction in your taxes after you hold for 5 years. And oh, hey, if you go into a rural opportunity fund, you're going to get a 30% reduction in your taxes when you pay them in 5 years. Same 10-year step up in basis to fair market value applies, but that rural play, really made a difference. And so we're really excited to see what happens with that. And we got a lot of people that are pursuing rural deals now as a result.
Okay, I understand, and it's really exciting. But let's go first as a first step, right? You got your capital tax gains. If the same year, so in real estate, we use 1031, right, to defer it.
Yep.
So in this case, if we use opportunity zones, we don't have to use 1031. We just put it in an opportunity fund.
That's right. And you get to defer the tax. If you do it now, and as of, us talking about this is October of 2025. If you do it now, you're going to defer it until December 31st, 2026. If you do it after January 1st, 2027, you get 5 years no matter when you put it in. And so people are kind of like, well, man, I'm just going to wait till January 1st, 2027. There is a play, and there is a reason why you might not want to do that. Because if you invest between now and December 31st, 2026, when you go to pay the taxes, you either pay your original gain amount or the value of your QOF investment at the time, whichever is less. So it creates this kind of unique opportunity that if you can show a valuation discount on paper, you can pay much less tax. And if something's under construction or there's a lack of control or a lack of marketability, a lot of times you can discount it by upwards of 50%. So it allows you to not only defer it, but then when you go to pay the tax to reduce it And then whatever your new investment is, after you've held that for 10 years, not only is it going to eliminate the capital gains tax, but it's also going to eliminate depreciation recapture. So as it relates to 1031, it just depends on what your strategy is, but I think that it's a lot better because we're talking elimination, not just deferral. And also, we use this to solve failed 1031s all the time. When somebody doesn't designate or whatever, we can now roll their money into a qualified opportunity fund as soon as they get it back. They've got 180 days from the time they get it from the QI, and we can put it into a fund. And now we're able to defer their taxes until December 31st, 2026, which that time gives us the opportunity to be able to do creative things to reduce their taxes that are going to happen in 26, in addition to the valuation discount, solar deals, bonus depreciation, equipment rental, other kind of tax mitigation strategies that we regularly put people into.
Okay, for folks listening, guys, you have to stop here. You have to rewind it all back, get your notebooks, and write it down. This is a lot of golden nuggets right here, Ashley. Thank you so much. I'm gonna listen it again. I'm gonna make
We're hitting you with the fire hose, but once again, we're happy to unpack all of this stuff, and that's what we do at OZ Pro.
So couple key elements here and very important stuff. Because I'm planning 1031, I'm in the process of selling some of my properties, and I'm thinking, why do I do 1031 if I can just go with OZ, right? And it's the same process, right? You still can get a loan. It's just a fund that invested in the property under your name, right? And you still applying for the same loans like you buying with cash or you buying with 1031. It doesn't matter. It doesn't change in the process. And also one important information that I just hear is that if for some reason your 1031, you weren't able to find the property, right? Within the timeline, and then money goes back to, money actually sits in your QI. You can get this money and rotate it to OZ fund. Did I understand it correctly?
Yeah.
So basically,
as soon as the QI releases the money to you, now have 180 days from that date to get it into a fund.
Okay, that's helpful.
So we use it to help blown 1031s all the time.
Right, if the deal doesn't go through, guys. So you had 1031, the deal, it's in the final stage, but you found some extra 100,000 sewer bills or something happened with the roof and didn't change, it wasn't disclosed, and you passed due diligence, you need to close, and this deal is done, you don't have time to find another deal, then this is a way out, pretty much.
And the great thing about OZs is that once you get it into your fund, you've got between 6 months and a year before you have to drop it down to a QOZB. And then once it's at the QOZB, you have 31 months before you have to deploy it into an opportunity zone property. And so you've got between literally like almost 4 years to deploy your cash into an opportunity zone. So it buys you a lot of time and it buys you a lot of flexibility because it's your own qualified opportunity fund. And in the meantime, you can borrow the money you can borrow it, loan it out to yourself, and you can do with it whatever you want to with it. Now, there's some nuances about when you got to get it back in and how you got to work the timing on it, but it's definitely doable that you can access the money while you're trying to find a deal in an opportunity zone.
Wow.
One thing that is important as it relates to kind of one thing that you said earlier about that it's just the same as a 1031 with respect to like lenders is that you are putting it into an LLC. And so it is going to be a commercial loan. And it's really important that if you're looking at doing an opportunity zone deal, to not buy the property in your individual name and expect to be able to convey it into an opportunity zone business later on. There's two places where you can't have related parties inside of opportunity zones. It's one, how you generate the capital gain, and two, where you buy the property from. And so you don't want to do that. But if you create an LLC, we can a lot of times turn that into a QOZB later on. We call it an unintentional QOZB. And we get really creative with how we solve problems inside of opportunity zone land. And the regs give us a lot of flexibility to be able to do that.
I hear that, and a lot of information, a lot of to unpack. And I know you're going through this every day, but for us, it's a little harder to keep up. So I'm going to step back and ask you more questions. So you mentioned right in the middle somewhere is that rural and not rural opportunity zones. Can you unwind a little bit? What's the difference between those, and what are the rules in terms of investments and some other pitfalls that we can expect?
Yeah, so the definition is that a rural opportunity zone can't have more than 50,000 people in the census tract, or be adjacent to a tract that has 50,000 people. And so what they were trying to keep it out of cities and out of like suburbs that are around the cities. And so if you don't hit either one of those definitions, then you will be a rural qualified opportunity fund. And there's maps that can show that to you about which ones they are. Now, inside of a rural deal, you just have to be mindful of that it's rural. And so your demographics are going to be substantially different, but a lot of times there's alpha, right? There's opportunity to make money inside of rural deals because they haven't gotten the demand that a lot of the more urban tracts have. And so we have a lot of people that do rural deals.
In terms of qualifications, so we had this conversation with you offline, and you mentioned something about that you need to spend this much money to qualify to opportunity zone. Can you expand?
That's actually a good one. I appreciate you bringing that back up. So when you buy property inside of an opportunity zone, if it's raw land, all you have to do is just do something to it and put it into service. If it's got a building on it, you have to substantially improve the building. And substantial improvement means that whatever the value of the building is, you double that. So if you've got $1 million property that you're buying and the building itself is worth $550,000 of that $1 million purchase price, you're going to have to put another $550,001 into it. And so it's really important how much that building is worth. Now, under 2.0 in a rural area, and actually as of July 4th, even under 1.0, in a rural area, that substantial improvement threshold goes down to half. And so you only have to put half, like 50% of what the value of the building is in order to hit substantial improvement. So once again, kind of another reason why people are looking at rural deals, because the substantial improvement threshold is substantially less.
Yeah, and if it's not rural, so do we have to invest till half, or is it the full amount?
No, it's the full doubling of it. And so
doubling of the property value. So the land value stays the same, right? Regardless.
Correct.
And we just need to, and the land value is based on assessor's office on their valuations.
It's however you can prove a paper trail associated with it. So we highly recommend that people do appraisals. But if you've got a good assessed value and you can put that in as your, as what your building versus land breakdown is, then yeah, I think that you could, that you're probably going to be okay with that.
But in your experience, it's a good idea to get an appraisal, and sometimes you can get more value from the land, right?
Yeah, and a lot of times as well is that just depending on what jurisdiction you're in, the land, the assessor's office might not have caught up to current market values, and so it might be a little bit wonky. And so you might be better off going and getting an appraisal done so that you can get whatever it is that you want relative to that valuation delineation. Now, one thing that's real important as you're doing that is to take into account kind of what you think that you're going to end up spending on improving the property. So if you're buying a $1 million property and you're planning on doing $750,000 worth of improvements to it, you don't want to go in and allocate as little as possible to the existing building. You're probably going to want to allocate $750,000 to it, because that then becomes the number that you can bonus depreciate via a cost segregation study. And so you don't want to underchange yourself either, which is why sometimes an appraisal works out well. And a lot of times what we do is we have somebody go do a cost segregation analysis and have that person that's doing the cost segregation analysis actually come up with the valuation for their substantial improvement threshold, because they certainly have the credentials to justify it.
Absolutely. And experience. Just so I 100% clear, I'm going to ask this again. You already answered, but I just want to clarify. If we do buying it with opportunity zone fund, we still can do bonus depreciation and cost segregation. And in the end, if we hold for 10 years, there's never going to be depreciation recapture.
That's right. Now, once again, there's some nuances to it relative to how you can use the bonus depreciation. And the reason is because when you invest tax deferred money, you start out with zero basis in a qualified opportunity fund. And in a partnership, you can't allocate losses in excess of basis. And so if you get debt on the property, more than likely you're going to be able to take advantage of the full cost segregation bonus depreciation. If you don't have debt, it might just be held up until you pay the taxes on it or until you have income. And then you can use the cost segregation and the depreciation to offset the income that's coming in off of it. So once again, just some nuances, which is a very important thing to note about the program, is that it's actually fairly simple when you get into it. Seems a little bit complicated as I'm hitting you with the full Monty of this, in the course of an hour, but it's really not that complicated, except that there's some nuances that if you don't do this on a daily basis, those nuances can be a little bit hard to understand, which is why that it's important that you have professionals that know what they're doing to help you out with it.
100%. In any real estate deal and any other deal, you always look into hire a mentor, right? An opportunity zone, it's like you providing this mentorship, your expertise and your service to guys through the process. And I think it's extremely valuable, especially to go through this process at least once and understand it. And I feel like people will go through this process once they understand it's going to be easy with you, and they're like, okay, let's just keep going.
Sure. Well, that's just it. It's kind of like me. I owned so after I did that first deal, I ended up doing a bunch of mobile home parks for better part of 20 years, and bought, sold them, renovated them, flipped them, all of that kind of stuff. And I had one left, and I was like, well, I need to do something with this thing. I either need to expand it or I need to do something else with it. And I was evaluating, and I was like, wait a second. I could either invest the same amount of time and energy into this, or I could sell it right now, and I could take that capital gain and I could put it into a qualified opportunity fund, do the same amount of work, exert the same amount of energy, and I'm going to make 24% more on my energy in this deal than I do in that deal. Which one am I going to do? So I listed it the next day and sold it and used that money in order to seed our fund.
And again, it doesn't, just to explain again to our listeners, guys, it's not only about real estate. If you have a huge stock portfolio and it's performing super well, you can do exactly the same thing and put it in an opportunity fund and then reinvest into business or real estate, correct?
That's right. And where it really gets powerful, and we do a lot with business brokers, is somebody that's selling a company, they're probably going to continue to do something else. And so we sell their company, we defer all their taxes via an opportunity fund. They have access to the liquidity if they need it. And then they go and they figure out what their next step is. A lot of times they're going to start another business or buy another business, and they're able to do so in the opportunity zone. And now as they grow that business and they hold it for 10 years, they're going to be able to exit it completely tax-free.
Yes, I love it. Listen, so you must have a ton of history on opportunity zones, right? And you must have a lot of interesting stories. So share with us, do you have one favorite story about how it helped the owner or buyer on opportunity zones to defer? What was your biggest check today?
Ooh, the biggest one that we've done to date was 80 million. And I'm working with a gentleman right now that's got 450 million. But we haven't solidified that deal yet. And I'm just like, dang, man. There's a whole nother league out there, right? And so he's going to create his own family office with his 450 million. He's hiring professionals. And if you have a family office, you're crazy not to be doing opportunity zones. Once again, because of the ability to be able to hold tax-free for so long. And so a lot of people are now revising their mindset relative to selling after 3 years to get that IRR bump, because they're realizing the transactional drag on their return. And so they're looking for ways to hold for a long period of time. Well, what better way than to use the eighth wonder of the world, which is tax-free compound interest over a 30-year period? That's what opportunity zones present. But I digress. So going back to your question, one of my favorite deals, I got two. One is just kind of the ingenuity of it and kind of combining the two of the real estate with the operating businesses to take advantage, not to take advantage of, but to deal with an issue that we are dealing with today. So I used to be in the mergers and acquisition space, helping people sell businesses. And we were all talking about the silver tsunami. That is upon us. And, the baby boomer generation is aging out of a lot of businesses right now. And particularly in rural areas, there's not people that are there that have the desire or the ability to be able to take those businesses over. A lot of time the next generation doesn't want them. And so there's this gap and this potential vacuum that's going to happen relative to those jobs going away if somebody doesn't step in to do that. So this gentleman built a flex industrial warehouse in a rural area, and he then staffed it with a kind of a back office for accounting and then a back office for scheduling and just kind of generally coordinating things. And he then made that available to people as an additional accoutrement to their rent, right? Where it made it more attractive for them to go and be a tenant in his building. He had all of the, industrial roll-up doors and storage space and stuff like that. And then he was able to give them this service. And then what he did was the ones that showed promise and that showed acumen, he then made a lead investment with his fund into their deal, turned them into qualified opportunity zone businesses, helped them recognize a capital gain to be able to lock in their value tax-free over the next 10 years. And now he's got his little mini private equity fund that he's doing out of this space. I love that model. And I think that it serves a really important community need that's happening right now. My second example was a gentleman that he had a failed development. It was literally like a stub farm, like, where you have all the little PVC pipes and stuff like that sticking out of the ground from the Great Recession. And it was lakefront down in a state that's, and I'm not going to mention the state because you might be able to zone in on exactly which one I'm talking about, but it was down here in the Southeast. He then took that development. So he bought it, and he bought it at he got a great deal on it. He started a farm on that development, and then he started building houses, right? Like multifamily, I don't know, it's like fourplexes on these lots. So instead of like big McMansions, he built fourplexes, and then he would rent those fourplex units out to autistic people from around the country. And so he created this autistic community there where he brought in the service providers that were needed in order to provide for their needs relative to just maintaining, therapy sessions and all that kind of stuff, care for them. And then he had a job for them in his farm that was growing chickweed, which is one of the most popular, cleanest sources of plant protein out there right now. So I was like, whoa, dude, like you got it all happening right there, man. I mean, so that's one of my favorite examples of just kind of the ingenuity of taking, innovative concepts from these different areas and plugging them together and making it work.
I love it. I had another guy the other day, and she's working on a project to create a multifamily project for autistic kids.
Yeah.
And just families and her idea is to have a sustainable, right? So the parents with autistic kids can invest in it and have it paid for its own. Like the project will sustain itself from the rental side of a rental and live them together, not just segregate them, living separately, but live them together in one community.
Correct.
With not autistic. This way, everyone feel normal and it's good and it's reliable. And she's working on it. And I like how you mentioned that building out communities and creating this environment to help us. I think there's a big need. I think there's a big epidemic going in the United States with this front. So it's very good to see people actually work in this direction, helping others and actually utilizing tools available from our government, right? Sure. To actually make it happen and make some money in it.
Yep.
So that's the best. It's a win-win for everyone and helping community along the way. I love it. So opportunity zones is very intriguing in general. I have one particular property I want to ask you. So we are under contract for 121 units. We talked a little bit about it in Kansas City. It's opportunity zone. The problem here is we are buying it already almost finished to develop. So only 20% units left over to be renovated. And but there is and the renovation schedule is not that many. So we're buying for 8.8 million. The renovation is for 500,000, right? So obviously it's not going to qualify. But there's two things there, right? The one is there was one building, 4 units, townhome got burned, and they redeveloping those for 1.2 million.
Okay.
And before that, there's this company that bought an else group. They've been renovated 80% of the units for the last 5 years. So they've done some substantial improvement. So my question to you, do we still have a shot for opportunity zone? Is there a way out from what I have limited budget can we do something creative here and tap into the existing renovations that has been done on this property if they not utilize the opportunity zones themselves?
Yeah, so it's going to be very difficult unless you're able to, and we call it an unintentional QOZB. So you cannot bring your fund and buy membership interest from an existing, right? So like what I would normally say is, hey, let's just buy the membership interest of the entity. And then that way you can get all the benefit of all of the money that the existing owner has poured into it in the form of renovation. The challenge with that is that if we put money into that entity, unless we're going to repay debt, we then have a problem with what we do with that, because it's got to be original issue membership interest for cash. And so if they had debt on it and they can repay the debt and then we can wait 2 years to take them out, then potentially. The other problem is that it sounds like the existing owner didn't do all of the renovations. They actually bought it from somebody else that did the renovations prior to them. So if that's the case, then unless they doubled the value.
No, I think they did.
Oh, they did.
They
Okay.
did renovation.
So
but there's more that it's assumable loan. So we're gonna assume their loan.
okay. Well, then that's
So
perfect. Now, here's the problem: if they want to take cash out of the deal, then that's going to be a problem, because they can't take cash out for 2 years because it'll be considered a disguised sale if you do. And once again, we can't buy membership interest at the QOZB level. We have to make an investment into the QOZB, and then we can redeem out people after 2 years in order to get around the disguised sale rules. But that would be the only way to do it. Now, you could set that up to where you held that money in escrow, or you paid down the existing debt, which I don't necessarily know that you want to do. If you'd actually have enough time probably to put it in escrow, and because you have 2 years and you got a 31-month working capital safe harbor, you could put it in escrow, and then you could use that cash to redeem them out after that. Might be a little bit difficult because you also want to avoid substance over form, where if you've got all that documented ahead of time, that might be where the IRS is like, nah, you were just selling this, So we'd have to look at the details of it. That's where it gets a little bit complicated, is if you've already done a bunch of work to something, then it can get rough in order to hit that substantial improvement requirement, unless you're able to work it to where you can come in and buy their existing entity.
But the best and cleanest way is actually to start it on its own, new fund buying and renovating. So
That's exactly
look for
right.
the properties that requires 100%. If it's not rural opportunity zones, and then some properties that require substantial renovation, and you just come in, you renovate this place, and you just utilize entire full package.
That's what it's specifically designed for, right? Is that they wanted people to come in and to redo and to make areas nicer. So it goes, if it needs substantial improvement, that's going to be one. Or if it's got raw land adjacent to you where you can do new construction and you can hit the substantial improvement requirement that way. Or if it was a hotel and you needed to put a lot of FF&E into it, the FF&E will count towards your substantial improvement threshold as well. Like any kind of personal property that you buy for the actual thing that you're running there.
And you just mentioned something interesting, self-improvement. So if I'm buying, for example, I had another deal that I was brainstorming, 7-unit, let's say, and we are going to knock it down and we're going to build 100 units on this property. It's obviously substantial value.
Yeah.
So is this something, the ground up development would actually work for something like this?
Absolutely. And if you're going to demolish something, then that's basically treated as raw land and you just have to do something to it. Or if it's been vacant for 3 years prior, then you get to treat it as new original use as well. So raw land, demolition, or abandoned, that counts as original use. Or if you're going to do, right, like what you're talking about right there, where you're going to do a massive new development, that would work as well, because there's no way that you're absolutely going to double the value of that improvement.
So the only basically policy is the requirement is to double the main requirements there to double the improvement value.
That's right.
And if we build in something new, or if you have community and next door you build something substantial value, similar size, then also it's probably will be the same or even less size, but it's cost to build much higher nowadays.
Yeah,
So if you
exactly.
build something,
You're going to
so
probably spend it. That's right.
gotta probably spend it, right? So from your lifetime of working on this opportunity zones, what's the biggest misconceptions for investor about opportunity zones from your experience?
Well, the biggest one, and I think that this is rapidly changing, is that the program, expired, or that it was going to expire too soon to, for it to be worth somebody's while. And I think that that's continuing to be a misconception as we kind of go into 2.0, is that, oh, I'm just going to wait till 2027. And the answer is don't wait, because there's a unique opportunity and a closing window to be able to utilize that December 31st valuation discount. And I think that we're going to be inundated with people wanting to do that. And so it's like, man, get in the game right now. And I think that that's kind of the biggest misconception that I see, is just people's misunderstanding about the timing of it and whether they should fool with learning about it, because they're like, that's just going to go away. Well, it's not anymore. It's here to stay. I think that it has the opportunity, right, to be more ubiquitous than 1031, just because I think that the power of it is greater than 1031.
Usually, and large deals holds anyway, so 5 to 7 years. What is it to hold for another 3 years? If it's deferred, if you wiping out all your 1031 deferred capital X gain and everything that rooms of property, that's
once again
extremely valuable.
I wish that I would have held every piece of real estate that I ever bought here in Charlotte. And if and going forward now, I'm looking to hold every piece of real estate that I buy for as long as I can, to let it appreciate in value. And so that's the great thing about this program, is that it's not how long you have to hold it, it's how long you get to hold it. And the answer is 30 years. So if I can hold on to something and let it eat tax-free for 30 years, that's going to be one gigantic fat cow that I'm going to be able to harvest without having to give a quarter of it, literally over. And that's at current capital gains rates. I got to give 25% to the federal government. And then then you got your state taxes. So with OZs, man, I get to keep the whole thing for me and my family, as opposed to, having to invite the government to the table for at least a quarter of it.
Yeah. No, extremely powerful. Wow. So, and about opportunity zones. So, if we have a real case scenario, I have a few properties I'm selling. I have partners on those. If I'm planning to invest in opportunity zones and I'm inviting others to this, all parties should create their own opportunity zone fund, or it should be under one umbrella? A few partners could be, and how does it work?
Yeah, so I'm glad you brought that up. That's another distinction with 1031, because in 1031, if you've got partners, everybody's got a role. Not in OZs. You can distribute out the gain, and each person can decide whether they want to invest into an opportunity zone fund or not. When you're doing an investment, a lot of times I do recommend that people do their own individual fund, just so that way they have the flexibility to be able to invest into other things should they so choose. And, one of the, I regularly say this, that one of the most powerful vehicles that people are going to have in their tax mitigation toolbox is going to be an aged opportunity fund, because you do not have to hold each investment for 10 years. You just have to hold your investment in the fund for 10 years. And then everything that's owned by the fund is eligible for the step up in basis to fair market value. So for a house flipper, the house flipper could set up an opportunity fund, put $100,000 in there right now. And then in 2035, they could have, let's say they own 10 properties. Well, they sell one property out of that, and they're able to take that out, and they're able to harvest that, and to take the step up in basis to fair market value. But they could also use leverage. They could borrow against the existing assets that are in the fund. They could go buy another house, basically fix it, and then flip it 367 days later. And as long as they held it for investment purposes, so you have to make sure that you're complying with that, you're going to be able to take the step up in basis to fair market value on that asset. Even though you haven't held the asset for 10 years, you've held your fund investment for 10 years. That's what counts. And so the old Chinese proverb, when was the best time to plant a tree? 30 years ago. When was the best time to set up an opportunity fund? 2018. When's the second best time? Today. And so that's the thing that, I think that people need these, and that they are best served to have their own. And then you could co-invest at the QOZB level. So you could have 10 people that each have their own fund, and then they could all partner together at the QOZB level, and they could go do one deal.
And if I have multiple deals that I'm selling right now, separate entities, can I have all of them packaged in one opportunity zone fund?
Correct. And you can use that fund for every new capital gain that you have. Now, you may want to evaluate that with respect to what kind of assets it owns, because each tranche of capital that comes in has its own 10-year clock. And so if you're going into the same asset, you may want to look at setting up a new fund, after a couple of years, so that way your new assets and your new deals have their own 10-year clock.
But basically, if I'm selling chunk right now, a few different properties, it's the same particular time, it's a good idea to put it in one fund.
Put it that way,
because the 1 month plus minus, it has the same similar
totally fine
timeline on it.
And that way you only have to file one tax return.
And now, wicked interesting question. If I have opportunity fund and invest in property, we are funding renovation from that opportunity fund as well. We get a loan, we fund it with renovation from this fund, right? And later on, what happens if we do cash out refinancing on this property?
Man, I can't believe I didn't bring that up. Is that you can completely cash out all of your money out of the deal after a 2-year lockout. So there's a 2-year lockout from the time you invest into your fund before you can do a cash out refinance. But then after 2 years, you can completely pull all the money out, and there's no taxable effect.
From the property.
Correct. So let's just use an example. You had $1 million of capital gains, and you buy a $500,000 property. You put another $500,000 into it. So you got $1 million into that deal. You then go and you hold it, you get it stabilized. 2 years later, you're like, man, I need some cash. And you go to a lender, and the lender's like, yeah, I'll actually give you 1.2 million on it because it's gone up in value. And so they loan you $1.2 million. You could take that $1.2 million out of there, and you can do whatever you want to with it. You could go buy a yacht. You could buy a boat. You could put it into another deal that's non-OZ. If you're going to refinance and put it into opportunity zone deals, there is no timeout, right? There's no 2-year limitation. You could do that immediately. So as soon as you stabilize it, you could go to a bank, get a loan on it, and put that money into another deal in the OZ.
But, oh my God. So in 2 years, basically, even if we don't go for opportunity zone funds, I mean, technically when you refinance, guys, consult with your CPA. I think you're supposed to reinvest in real estate if you do real estate when you're refinancing. But generally speaking, oh my God, you just unlocked the whole universe for me. Like, this is my light bulb. Okay. Sure. I strive on there. This is what I've done before. And right now I'm focusing on these properties that I can refinance in 2 years, substantial. And not necessarily we're trying to go and put all money, just buy it with cash, but we're going to leverage from the beginning. We'll put 500,000 leverage by 2 million worth of property, invest another couple $100,000 to renovation, 500,000. But this is a question, right? Opportunity zone. You have to, if it's property value is 2.5 million, you have to invest, renovate 2.5 million worth of, make improvements on the property.
That's if the building is worth 2.5 million. But if it's not, it's whatever the building's worth. That's how much you're going to have to put into it.
Right. But also minus land.
That's what I'm saying.
Right?
Yeah, you get to exclude the land out.
Got it. Yep. Okay. I have to really watch all of this episode again and unwind it. And I highly recommend to our listeners to do exactly the same thing because it's wicked important. Okay. Ashley, I have one of the last questions for you. For someone listening who's never explored opportunity zones, what's the very first steps they should take today to start moving in that direction? Yeah,
so we've actually got a masterclass that's available at ozpros.com. And you can there's all kinds of buttons on there about how you can take the masterclass. And it's going to give you a general overview. There's also kind of There's different things that you can do on there relative to like a calculator and other things that if you're curious about. We've got a map at ozpros.com/map if you want to find a property to see if it's in an opportunity zone or find the nearest opportunity zone closest to you. And then if you're ready to roll, if you want to learn more, we've got it's a mastermind group called Ascent. And I think that that's the fastest way to get a PhD, to go from literally, we've got people that have gone from zero, like no knowledge about opportunity zones, to not only doing their deals, but actually advising people, about how to give them correct input on their deals through our mastermind. And that's a weekly call with me, and it's an hour and a half long. We charge $400 a month for that. Where my hourly rate's $1,000 an hour. But it's $400 and you get 4 calls. And if you go to ozpros.com and you submit your information on there, I'll give you a month for free just because you're a listener of this podcast. And people can jump in there and they can ask questions. They can learn from other people's questions. And, then they can also, if they've got a deal, we've got a specific deal spot where you can drop information in there. We've got about 150 people in the masterclass itself, about 500 people in the community. And so there are other investors in there who are looking for deals. And we've had a lot of people that have had success in finding investors and or joint venture partners through our mastermind. It's become a pretty cool community.
Love it. Love it. I like that it's not only you guys advising, but it's also creating a little environment there for people invest in each other deals
Sure.
and collaborate. I think it's all about your network is your net worth, right? And that's how we're doing all of this. We meeting people, and now you enabling people to do the deals inside your community. I love it.
Well, and that's
it's very, very powerful.
Yeah, that's what it's all about for me, is that I'm, at this point in my life, I'm way more interested in the relationships that I have than in how much those are going to make me. And so I'm trying to help people to connect with people and to get really vibrant interactions and to build, relationships with people that they can trust. And the people that we have in our community that regularly come are just great people. And I love to be around them. Tuesdays are my favorite day of the week now.
Awesome. And I forgot to ask you, and it's wicked important, what is opportunity cost here to set up fund like this for people?
Yeah, so we set them up. Obviously, you could do it yourself. It's actually not that complicated. If we do it, it's $12,500. If you want us to handle your first year of compliance, because the great thing about opportunity zones is that you don't have to get permission from anybody in the government, but you better have a really good audit trail. Because ultimately, 10 years down the road, the IRS could come and ask you to prove that you did everything correctly. And so you're going to need to have an audit trail that is succinct and that is correct. And that's what we do within our compliance program. We build that out for people. That's $17,500. So it's $12,500 plus the $5,000 to do the first year audit trail. And then we assess it from there, just depending on the complexity of it. But that's generally what people, if we're going to set it up, that's what we charge. Now, if somebody wants to come in and do it themselves, they could literally join Ascent. We've got an intellectual property fee that they can pay, and they can get access to all of our form documents that we use. And if they want to do it themselves, that would probably be the cheapest way. It's $3,000 for the IP fee, and then it's $400 a month to be in Ascent. And so they could literally jump in. We've got I think I've probably got 15 hours worth of educational content that's inside of Ascent. And, people can consume that, or they can just come to the weekly sessions. They can ask me about the specifics. But if they wanted to do it themselves, but they wanted to do it with some, forms and some backing, that would be the most kind of cost-effective way to do it. And so we try to make it available to as many people as possible. But at the same time, I got overhead, and it's a lot of time and energy to make sure that we do it correctly. That's what you get if you pay us to do it.
100%. It doesn't matter location where you're located, or it's federally the same?
So each individual state, there's about 5 states that have exempted out. So that's California, Mississippi, I want to say Massachusetts, New York, Illinois got legislation out there. And believe it or not, North Carolina exempted out. And I think it was because the Republicans that were in office at the time thought that this was another kind of liberal money grab, right? Relative to like different economic and development incentives. And so they're like, we're exempted out of that. And unfortunately, they haven't gotten us back into it. But if you're in one of those states then that don't recognize it, you're going to pay your capital gains at the state level. And so a lot of times what we'll do is we'll set up the opportunity fund in an adjacent state or in a tax-free jurisdiction with the understanding that that person's going to move prior to their 10-year hold or when they sell on the backside, so that way they get the big benefit tax-free. They don't get the deferral offset, but they'll get the big benefit later on. So my fund is in South Carolina.
Love it. Love it. And in terms of making deals, you stubborn fund. You have, for example, multifamily property. The incomes that come in, you paying just general partners income. You don't have to pay fund that income, right?
No, yeah. So it depends on how you set it up. Most people set up their funds as partnerships. And so that's going to pass through to each individual partner on the income. And so that's where your bonus depreciation and your depreciation comes in to reduce that income down. If you're really minting cash, we've got some creative tax solutions that can help you to mitigate that income tax. I've actually got a really cool one that's a insurance product with a insurance company down in Puerto Rico. And you can own your call option on that insurance policy through the 10% that's available in your qualified opportunity fund. And you can basically make it so that it grows. It becomes a deduction for you along the way, and then it'll grow tax-free. And you can actually exercise it on the back end. But you need to be doing around $2 million in revenue in order to justify that. But like I said, that qualified opportunity fund and that aged qualified opportunity fund is an unbelievably powerful tax mitigation tool. And it allows us to do a lot of creative stuff.
And bottom line, hire a professional, guys.
Yeah,
try not to do it by
absolutely.
yourself. And you can definitely make research in entrepreneurs too, but always consult with professionals. You have your rockstar team and Ashley Tison here to help. And thank you, Ashley. I appreciate you. So I have quick hits lightning round
Sure.
real quick. One book or resource that shaped your mindset or investment approach.
So I use, and I always auto default back to EOS and to Traction. That was a game changer for me and as it related to my business. And we use Traction. We use the EOS model inside of our business, and that's made a big difference. So I would recommend Traction by Gino Wickman.
Most important trait a business leader should develop.
Yeah, I was thinking about this one earlier. I think that it's a lifelong quest for learning. You know, continually wanting to learn and continually wanting to try to apply the things that you're learning, even if you fail. Because that, that's what establishes grit. And I think that grit is the most important trait that somebody can have, but you can't just get grit. You can certainly, motivate yourself to learn though, and then to get out there and to get after it and then learn from your mistakes, which establishes grit.
You can only learn from the failure because it's from failures we learn the best. And this is experience. At the end of the day, it's all experience, right?
That's exactly right.
And there is no such thing as bad experience. It's still good at any point given. So another question. One thing you wish you knew earlier in your real estate journey?
Wow. On the real estate side, looking back on it, I wish that I would have kept a lot more of the properties that I had, just because I'm sitting here looking at how much they're worth now. But at the same time, it's like, to your point earlier, it's like, man, I got it. I transacted and it worked out well. I think that I wish that I would have known about focus that I got through EOS a long time ago, because I was kind of scattered relative to lots of things that I was trying. And so, like that focus piece, I think would have been really key for me if I had learned that earlier. And then I have a finite amount of time and energy, and that's why focus is essential, so that way I can apply all of that time, energy, and resources to that one thing and do it really well.
There's a book, The One Sin. I forgot who the author is, but it's about that. It's about targeted approach. Very, very unique. Okay, Ashley, I have one last question for you. If someone wants to learn about opportunity zones, what is the best way to find and talk to you about it?
Yeah, so ozpros.com. And if you go to ozpros.com/podcast, we got some special offers in there. Submit your information. and you can either get on a 15-minute call or you can directly join Ascent, and we'd love to have you in there and would love to help you expand your opportunity zone horizons and get you started on your OZ journey. Some people call me the Sherpa, and I love helping people map it out, strategize about it, and then actually, walk the walk and go to the top of that tax savings mountain.
Before talking to you, I had this whole strategy about 1031 exchange and now be smart about it. And I know how to do it. I got consultations and I'm like, okay, I have to now explore this avenue, dive deeper into it, and make sure I totally understand what I'm going to do. But
there's a place for both.
I'm actually wicked excited.
There's definitely a place for both. And that's one of the things that we also, and we flesh that out inside of our Tuesday calls. We'll talk about the specifics relative to a person's specific situation. And then we'll determine, okay, well, all right, where you are, 1031 actually probably does make more sense than opportunity zones. So the lion's share of people, it's actually probably going to make a lot more sense to do OZs, particularly if they've got big visions about what they want to do, where they're going to be potentially approaching that lifetime exemption amount of $30 million for a joint for a married couple. And if you're going to even sniff it, opportunity zones are the way to go, because 1031s can get really expensive for your next of kin.
100%. Ashley, that's it from me for today. Thank you so much. I mean, this was an incredible deep dive.
Sure.
I learned a lot of new stuff, and I'm going to dive even deeper now. And I'm going to watch it again. I'm going to make some notes, and I'm going to call you to discuss.
You're going to jump into Tuesday's Ascent, and I'm going to see you next Tuesday, man.
100%. I'm going to sign up for it.
Awesome.
And listen, thank you so much for coming in today.
Appreciate it.
I really appreciate you coming in.
Yeah, honor and privilege, man. Thanks for having me.
Thank you. And to everyone listening, if you enjoyed this episode, don't forget to like and subscribe and leave a review. It's helping us to get out there and help you to bring such a quality episodes and quality content like with Ashley today. And as always, keep moving forward to the next one.